Hi, this is Dr. Vicky again. We are now going into another financial statement that is very critical for the operations of a company. The income statement is a summary of the income that's been brought into the company, as well as the expenses that the company pays as it moves along. So we're going to describe some common operating transactions, very similar to what we did on the balance sheet. You're going to have a list of, for your homework, you're going to have a list of transactions that relate to assets and liabilities and income accounts and expense accounts. So as we move along, jot notes down. If you have questions, please let me know. You can either send me an email or a text message. All right, so the operating activities include these tasks that are performed usually by different people within the company. However, it could be just one person, especially in the role of a self-employed business owner or a sole proprietor. So it includes buying goods and services from suppliers and employees, and then selling goods and services to customers, and then collecting cash from them. And then, of course, when it comes to your employees, you're paying them wages. And a lot of times, companies don't want to take the risk of being in trouble with the IRS, so they hire a HR company to run their payroll for them. So we'll get into those kinds of transactions as well. And this is like the cycle. It starts with buying goods and services. You pay cash to suppliers and employees. You sell the goods and services, and then you collect cash from the customers. This is the accounting cycle for your income statement. So when you're buying goods and services, the business, this particular example, the business is receiving $30 worth of supplies, and then the business gives a promise to pay of $30. Again, just like the balance sheet, every transaction involves two things, and every transaction, there's an exchange. So here again, this transaction is exchanging supplies for the promise to pay. The next one, the business receives a release from the $30 promise to pay because the business gives cash on when they paid it. Now, step 2 does not have to be done before step 3, but the goods and services that the company sells, for example, the business receives a right to collect $50 because it's giving services at a price of $50, perhaps an hour's worth of work for $50. And then the company, whoever is in charge of collecting, will receive the $50 cash, and the business gives up the right to collect the $50 because it has already collected it. So here in Exhibit 3.2, we have the income statement. Just like the balance sheet, this is a common format that is used across most all companies. The only difference you might see is some service companies, like there's a salon that I help manage their books, and she likes to put all of her services that she pays her employees, as well as the products in the salon, under cost of goods services sold. So in between revenues and expenses, you may see another section called cost of goods sold if it's a manufacturing company, or cost of services if it's a service company, like a salon. And then you have your expenses. And these expenses, when they're listed here directly under the revenues, and the revenues listed at the top, these are all operating revenues and expenses. There will be a time there could be a time where the company wants to do some investing. Maybe it has some side cash it doesn't want just sitting around, so it may put it in a savings account. So your interest income is actually doesn't have anything to do with the company and the services or goods that it sells. So it's other income, and it would be listed under the net income. The difference between your total revenues and your total expenses is your net income. So this gives an idea to the manager of how well they're doing. If this is a negative amount, then they have not charged enough revenues, or they've paid for expenses and have booked them. For example, we talked about cash accounting. So when expenses are paid for, they're not necessarily in the time period that the expenses were used. They're in the time period where the expenses were paid for. So sometimes the cash accounting can skew off the numbers a little bit, and this net income could be zero. So at that point, you're going to want to look at the year-to-date September 2021 rather than just the month. The heading on your income statement, similar again to the balance sheet, you're going to have the name of the company, the income statement, and what kind of income statement can be there as well. So this is a projected amount, and then it's for a certain period of time. So this could say for the month ended September 30th, 2021. So this is all of the month of September. It could say for the year to date September 30th, and that could be from January 1 through September, and it gives you a year-to-date amounts for the revenues and expenses. We just talked about this so that when you're on cash basis accounting record, the accounting is done. When cash is received, it's recorded as revenue in the time that it is received, and expenses are paid when the cash is paid. So in the first month, it could look like this. So we have paid for some expenses, but we haven't received any revenue yet. In month 2, we have received the revenue, but there are no expenses. So you see how this can skew the month-to-date reporting and why it's important to do the year-to-date, especially when you're on a cash basis accounting. Revenue recognition principles. So we have GAAP, generally accepted accounting principles, and we have IFRS, International Financial Reporting Standards. And then for the accrual basis accounting, we record revenues when they are earned and expenses in the same period as the revenues to which they relate, regardless of the timing of cash receipts or payments. For example, let's take a utility bill. So you get your utility bill for the month of April. You receive it in May. So what you're going to do is actually post that invoice in April. That way, the expense for April is going to coincide with the revenues that are earned in April. And then when you go to pay it, it's going to come off in the next month. And what I meant by that is that your cash is going to leave in the next month, where your expense is going to be recorded in April, the month that it was used. Timing of reporting revenue versus cash receipts. So the revenue recognition principle says that revenues are recognized when the seller provides goods or services to its customers in the amount the seller expects to be entitled to receive. So there's a 5-step model for reporting revenue. Number 1, identify the contract. Identify the seller's performance obligation, the company itself. Determine the transaction price, and then allocate the transaction price to the performance obligations. And then recognize revenue when each performance obligation is satisfied. So we will learn a bit more about these steps in the slides to come. But the thing you want to remember when it comes to revenue is that the seller should report the revenue at the time that it is earned. So if the cash is received in April, but the services are not performed until May, accruing the cash in a liability account means that, okay, you have cash, you can't just let it sit there in your books without recognizing the transaction. So your income is the cash received is going to increase your checking account, so that's the debit, but it's also going to create a liability because the company has not performed the services yet. So we create an accrued income account on the liability side, similar to an account payable, but we're just going to label it accrued income. And what that means is simply that you have received some cash for services, but you have not performed the services yet. So let's say that was done in April. The next month in May, whoever performs the services completes the work, and then the accounting department receives notice, okay, this work has been done, and they will do a transaction to remove the accrued income and move it over into service income. And so the way that works, and we'll get into the debits and credits of the income and expense here shortly, but your income is going to increase, which is on the credit side. So you're going to credit income or services revenue, and then you're going to decrease the accrued income account by posting a debit to that. So the first thing we're going to do is identify the contract. A contract is written, verbal, or implied. So this is step one. This is something that is being promised by the company. So sometimes if the services or products are not handed over yet or performed yet, then sometimes a contract has to be written because perhaps it's a major service or a large product that they're selling and the amount of money is quite a bit and they want to make sure they have it in a contract. So identify the seller's performance obligation. What goods and services does the seller promise? So in a hair salon, the seller is promising services in exchange for payment either with cash, credit card, however that is performed. So that is a situation where the contract is implied. You go into a salon, it is implied that when you get done receiving the services to get your hair done, you are going to make payment right away. Generally speaking, the salons, your nail salons, your barber shops, your accounting offices, your H&R Blocks, they're going to have set prices already, and you're going to know the prices before you enter into an implied contract. You allocate the transaction price to the performance obligation, meaning the transaction price is what is charged. That's the income that you will receive, and then you are applying it to that transaction. And then you're recognizing the revenue when or as each performance obligation is satisfied. When is a point in time that the service or product is delivered? If products are delivered over time, then that's another situation, perhaps monthly. So perhaps like your food companies nowadays that are sending out these meal packages. I've tried a couple of them myself. The food is very good. The recipes are very tasty, and you get the recipes. So you can experiment with those kinds of services. But it would be very time consuming for the company to bill for every individual meal or even each box that's delivered. So most of the companies, they give you a choice. Do you want 2 boxes, 3 boxes a month? And then how many meals you want in each box. You can have 2 meals, 4 meals, however many you want. So rather than charge for each individual meal or each individual box, those companies charge one time. And so that is usually in advance. The week before the box is delivered, they are going to bill the account. So not every meal is charged, but it's charged one whole price the week before it's delivered. And there are other examples that could be used as well. Your electricity bill, you don't pay for it as you go. You get one bill at the end of the month, even though you're getting service every single day of the month. The timing of reporting revenue versus cash receipts. So cash is received, a promise is given for the services. So this is going back to the initial example that we had where we received some cash in April, but didn't perform the services until May. So the asset's going to increase, your cash, and your liability is going to increase. You're not recognizing any revenue in April. Then May comes around. The services are performed. There's no exchange of cash again at this time, but the liability is going to go down because it's no longer something that is not earned. The cash has been earned, so the liability is going to go down and the revenue is going to go up. When cash is received and the service is given, the asset's going to go up and the revenue is going to go up. Revenues, the credit side is what increases revenue. Debits decrease revenue. Just the opposite for expenses. Expenses are debited when they are used. And if there's some sort of return or something goes bad and it has to be decreased, it's going to be decreased with a credit. So in this example, you have your sale and service before and cash after. So in this case, we have an asset and revenue to recognize. That asset is called accounts receivable because the services have already been provided. So you're going to recognize the revenue as well. Your asset's going to go up. Your account receivable is going to go up because it is an expected benefit that you are expecting to receive from your customer. And then your revenue is going to go up. And then when the cash is received, your cash is going to go up and your asset, the accounts receivable, is going to go back down. Record expenses in the same period as the revenues with which they can reasonably be associated. So what that is saying is, let's take our salon. I'm going to use that a lot because it's one of my favorite clients. So she actually has, not only does she sell services, but she also sells products. But at the same time, when she's providing the services, the salon is actually using some of the supplies that they have, like the shampoos and the conditioners and the hair colors and things like that. So those items are going to sit in supplies inventory until they're used. The products that she sells, in addition to her services, they're also kept in another inventory account until they are sold. So that's what it means by when the revenues are earned, you want to associate the expenses, and in this case, the expenses would be the salon supplies, the shampoo, the conditioners that are used to provide the service. So in this case, we have cash paid before the expense. So our cash is going to go down, but our asset is going to go up. And that's in our previous example with the inventory and with the salon supplies, both of those assets can increase or decrease on a monthly basis. Technically, they do increase and decrease on a daily basis, but again, because of the timing that she needs her reports, she really only needs her reports done monthly. So at the end of the month, I will do something like the next side of this transaction because the supplies are used up. So the asset, salon supplies, is going to go down because the value of the salon supplies is being decreased as items are being used. Then on the expense side, because the items are being used, we're going to put them on the income statement as an expense. Cash with an expense. So when you go to the store to buy office supplies, perhaps it looks like in this example, we're paying cash for our electricity. So the cash asset is going to go down and our expense is going to go up because the services have already been provided the month before. Expense before and cash after. So as I talked about the utility bill before, well, this example actually of advertising. So we have a contract for someone to do some advertising for us. So there is a bill or a liability that has to be paid. So it goes on the accounts payable. And then there is an expense that is being used, the cost of the advertising. So the expense is going to increase. Then you pay for the advertising. Your cash asset is going to go down and your liability is going to go down. So then the next thing we do, similar again to the transactions on the balance sheet, we're going to analyze, record, and summarize the effects of the operating transactions using the accounting equation, journal entries, and T accounts, just as we did before. So here's the accounting equation. We are going to analyze our assets and liabilities and the stockholders' equity in the account. Generally speaking, on the income statement, there's no activity for the stockholders' equity. So generally, you will never use the stockholders' equity in transactions for the income statement. The common stock and retained earnings are two accounts that the common stock stays as it is, and it doesn't, the income does not impact the common stock. However, as you're making these transactions for your assets and liabilities and your income and expenses, your retained earnings is going to increase or decrease. Expenses decrease net income and retained earnings, so expenses are recorded with debits, just like decreases in stockholders' equity. Revenues increase net income, which increases retained earnings, so revenues are recorded with credits, just like all increases in stockholders' equity. So what that is saying is that your retained earnings is a stockholders' equity account. So when we talked about this account in Chapter 2, the right side is our credits, and that's the normal balance. That's where the normal balance sits if it's positive. If the balance is negative, it's going to be on the left-hand side, and anything impacting the left-hand side is a debit or losses. So if your revenues, when your revenues increase, your retained earnings increase. And then when you're paying expenses, your retained earnings are decreased. So now we're going to go through the examples. So in September, the company sold $3,000 of apples online. Your cash is going to increase by $3,000, and your revenue is going to increase by $3,000. This is your recorded transaction. Cash is the debit. It's increasing $3,000. Your sales revenue is a credit, and you're increasing the retained earnings and stockholders' equity by $3,000. I said retained earnings, I meant revenue. When you increase revenue, you also are increasing the stockholders' equity. And then you summarize the transaction. So we have a beginning balance in our cash account of $20,700. We received the $3,000 for the apples, and then our sales increases over here as well. Next example, the company has issued 3 gift cards at the beginning of September. One thing you want to remember about gift cards is they're usually a plastic card that are purchased by people who want to give them as a gift. Even though the customer is receiving the gift cards, the plastic card, the company itself has not made the exchange because buying the gift card is for future services. So in this case, we're going to increase cash because we received the cash, but we're going to put it into an account called deferred revenue. Earlier, I mentioned accrued revenue. Deferred revenue is more likely what you'll see on the balance sheet for revenue that has not been earned yet. And normally, gift cards, they never expire. So this $300 can sit on here forever and ever. If they do expire, then they will be taken off at that time. But generally speaking, they don't, so they'll sit on the balance sheet until they're used. You're increasing your cash and increasing your deferred revenue, which is the asset and the liability. And this is what it looks like on your T accounts. Next example, the company sold the $9,000 worth of apps that they bought at the App Store on Google Play. So the accounts receivable is $9,000. And the stockholders' equity increases as well because they've sold $9,000 worth of apps. So in looking at this example, it is not exactly saying how it was paid for. So in that case, you're going to assume that it has not been paid for, and you're going to put it in your accounts receivable, which means that this $9,000 has not been received yet, but you're still going to book it in your accounts receivable because you expect to receive that in the near future. Then your revenue is going to go up as well. You do recognize the revenue because it's already been sold and your customers are using the applications. So your assets going to increase and your revenue and stockholders' equity increase. And here again is what it looks like on your T accounts. This one, the company has received a check for $8,500 from Apple and Google on account. You're going to increase your cash account by the $8,500, and then your receivables are going to go down. Because generally, when they are selling the applications, then the companies that they buy them from is going to owe them the money. So let's go back to our example again. So Noodle Cake sold $9,000 of apps in the App Store on Google Play. All right, so this $9,000 was recorded as an account receivable. We increased the revenue, so we're sitting here with this $9,000. The customers have paid Google, and Apple. So the company has now received from Apple and Google this $8,500, which is decreasing the $9,000 from the previous transaction. Increase in cash, decrease in your receivable, both on the asset side. Here's your cash coming in, and then here's your account receivable. You have the transaction prior has your $9,000. You've got payments totaling the $8,500, so $500 is still outstanding. The company wrote checks to employees for wages related to the hours worked in September. So the cash is going to go down, and you're increasing your wages expense. Wages, the expense is increased, your stockholders' equity is decreased, and your cash is decreased. Now, don't let these examples confuse you. Even though you see that your expense is increasing and stockholders' equity is decreasing, you are not going to book anything to your stockholders' equity. You're actually booking to the expense account, so wages expense here. And if I had written this book, I would have called this retained earnings rather than the stockholders' equity. Retained earnings is a part of the equity, but I don't want you to get confused with the stockholders' equity, meaning the stockholders' common stock, that kind of thing. So impacts to the income and expenses are all withheld in the stockholders' equity under the retained earnings. So again, wages expense, your expense is going to increase, which is a debit, and your cash is going to decrease, which is a credit. So here we see a decrease to the cash account, and your wages expense is the $7,800. Next part of the problem, the company has paid $7,200 in advance for rent for September, October, and November. And it was paid on September 1st when it's due. So these are going to impact, this transaction is going to impact two assets. Your cash is going to be decreased, and your prepaid rent is going to increase. Anytime you prepay expenses, which means that you are paying for expenses up front, but you won't be using those expenses until another month or as the month is lapsing. For example, here on September 1st, the rent is being paid. All right, so let's start again. Had to pause that for a moment. But your prepaid expenses, again, are things that you pay for in advance and will use over a period of time. So here we're going to record on two assets. We're going to record the prepaid rent, which will be sitting on your current assets, and then your cash, which is decreased. So on your T account, your cash is decreased and your prepaid rent is increased. Incur a cost, but you're going to pay it later. This is similar to your online ads, your utilities, different kinds of items that you are going to be billed for next month. So the company displayed some online ads in September and will receive the bill of $500 to be paid in October. So when you are working with these kinds of bills where the services are a one-time cost, they're going to be in your accounts payable, and your accounts payable, as we know, is a current liability. And then your advertising expense is going to increase as well. Advertising expense is your debit and your accounts payable is your credit. Getting back to the normal balances, I just want to reiterate the normal balance of your expenses is on the left side or debit side. The normal balance for revenues is going to be on the credit side or the right side. And here are your T accounts. Your accounts payable is going to increase, and then your advertising expense is going to increase. Paying for cash for expenses. So the company was notified by its bank that an automatic monthly payment of $600 was transmitted to its utility company for electricity use in September. So here's the transaction. Your cash is going down. It automatically came out of the bank account, and the expense account is going up, and that is also a debit entry. Sorry. Credit entry. Your cash is going down, which is on the credit side in the assets. Your expense is going up, so it's the debit side. Utility expense, but your cash is going down. In summary, you have your cash going down and your utility expenses going up. There's a lot of information on this slide, but these are the various different T accounts that we've used in this set of examples. And this is what you should have when you're working on your homework. And then at the end of the reporting period, you're going to calculate what the ending balance is. So for cash and all of your assets, your ending balances are all should be debit balances. They all should be positive. If it's negative, it'll be listed over on the other side. Similar to your liabilities, but your liabilities, the normal balance is on the right side or a credit balance. They all should be positive, but if one of these numbers turns out to be negative, it's going to be reported on the other side, and that happens when things are overpaid, which usually isn't too often, and so that would be a debit. The balance would be on the debit side. On your stockholders' equity, when you have impacts to expenses and you have revenues, it's impacting ultimately the retained earnings and the total stockholders' equity account. So here we're showing the common stock and the retained earnings. As of now, there hasn't been any previous activity, so it's at 0. Your sales is going to increase retained earnings, and then it's going to be offset by your expenses. But you notice they're kept in the revenue and expense accounts until usually at the end of the year, they'll roll over into the retained earnings account. So like your this is your unadjusted trial balance. So similar to what we saw on the balance sheet, you have your assets at the top, your payables, and then your stockholders' equity accounts. But now you're going to add your sales and your expenses. Similar situation. You have your regular side of expenses, which are debits, and your regular side for revenue is a credit. So that's where you're going to place them, under the revenues under the credit side, expenses under the debit side. At the end of the day, these two amounts should always equal. And this is one way where you see all of the accounts for the balance sheet and the income statement in one report. So we're going to review the revenues for just a moment. So this example, the cash is received before the revenue is generated, meaning the supply, the products or services have not been delivered yet. So the initial transaction for this kind of activity is that your cash is increasing, but since you have not earned the revenue, you're going to create a liability. So you're going to increase your asset and increase your liability. In Chapter 4, we'll learn how this gets reversed. When you get cash at the same time as the revenue is earned, this is just a simple transaction. Your cash is increased and your revenue is increased. And then when you receive cash after the revenue is generated, the initial transaction would be debiting your accounts receivable, because this is saying that your customer owes you the money, but you've already provided the services or the products. So your asset is going to increase for the account receivable, that expected benefit that you're going to receive later on from your customer, and a credit to the revenue side. And then, as we saw in example D, when the revenue was received, we increased our cash account and decreased the account receivable because they no longer owe us. Our customer has paid, so the receivable, the expected benefit, has been achieved. A review of the expenses for the same kinds of transactions. So here we receive cash before the expense is incurred. In our rent example, we're paying for 3 months of rent at one time. So we're going to put prepaid rent, increase in that asset, that current asset, and we're going to decrease our cash because we are paying for the expense. And then again in Chapter 4, we'll learn how these transactions are reversed. Cash at the same time you incur the expense. You can see the example in E that we looked at before, but other things could be like office supplies that you plan to use right away, meals that you've eaten out, things like that, where the expenses are being paid for at the same time. So your expense account is going to increase and your cash is going to decrease. And then lastly, cash paid after the expense is incurred. So here, this is when we have already used the benefits, but we haven't made payment yet. So there is still an exchange here going on. We are exchanging the expense for the promise to pay. So, for example, the utility bill, going back to the utility bill, that's the most common kind of expense that you usually don't pay until you get the bill. You are going to record the bill, and it's going to go on the books initially, an increase in your expense account because you've already received the services, and you're going to increase the payable account because you have yet to pay the payment. And then when we made the payment in the following month, our accounts payable is going to go down. So that is going to be a debit to your accounts payable, and your cash is going to go down, which is a credit. So evaluating net profit margin, but beware of income statement limitations. So this is going to go into another kind of ratio. So your net profit margin is letting you know how much of a margin is your net income compared to the revenues that you have received. So your net income divided by the revenues is your profit margin. So here, your net income is $12,000 less the expenses, which is the $8,900. So your total net income is $3,100. Take that $3,100 divided by the $12,000, and you're going to get a 0.258 or 25.8% of your revenues after you've paid your expenses. This ratio is a measure of whether the revenues are growing faster than the expenses. So this 25% is saying that for every dollar of revenue, only 25.8% is realized as in the net income, meaning your expenses are a little bit more than let me say that a different way. The net profit margin implies that Noodle Cake earned 25.8 cents on every dollar of revenue that it brought in. So this can vary from company to company. It depends on the services and the products or the products that are being sold. So there are some limitations. Your net income does not equal the cash. A lot of times business owners are asking me, I don't have a lot of cash, but why is my net income so high? And the reason they're concerned about that is because their taxes have to be done yet. And when they have a net income, but they don't have any cash, they don't have any cash to pay their taxes. Their net income does not equal the change in value, and then the net income is not always exact. Going back up to this first limitation, another example is when we do accrual accounting. So our net income may have expenses that have not been paid yet or expenses that are prepaid. So your net income does not always equal your changes in cash. And then your net income does not always reveal the change in value of the company. It may be up one month and down the next, especially in a cash basis accounting. So just because your profits are going down in one month, they could be right back up in the next month because of the cash way of doing accounting. And then net income is not exact. Sometimes the measurement that we put on transactions have to be adjusted. And so we will go through adjustments as we get further into the course. All right, so that brings us to the end of Chapter 3. If you've already done your homework, congratulations. But if you still have questions and want to make sure you do better on the chapter exam, please let me know. Thank you and have a great day.